IBM is 115 years old. It survived the Great Depression, the dot-com crash, and every tech revolution of the last century. And today, July 14, 2026, it just had the worst single day in its entire history. The stock collapsed around 23%, wiping out roughly $60 billion of value in hours, worse than its crash on Black Monday in 1987. But here's what makes this bigger than one company having a bad day. The reason behind the crash is a warning shot for the entire AI boom. Let's break down what actually happened and what it tells you about where all this AI money madness is heading. First, the crash itself. 8 days before its scheduled earnings report, IBM did something companies almost never do. It pre-announced bad news. Revenue came in at $17.2 billion, well short of the roughly $17.9 billion Wall Street expected. Earnings missed too. The CEO, Arvind Krishna, was unusually blunt in his letter to investors. His words, "We faltered." He admitted numerous large deals simply failed to close in the final weeks of June. Markets hate surprises, and they especially hate a 115-year-old blue chip confessing a stumble a week early. The stock cratered on the open, its worst session since Black Monday 1987, and by some measures, the worst ever. But here's where the story gets genuinely interesting, because the reason for the miss is the part that should make every tech investor sit up. According to Krishna, IBM's clients didn't stop spending on technology. They redirected it. In the final weeks of the quarter, companies rushed their budgets into servers, storage, and memory chips, panic buying AI hardware to lock in supply before prices climb even higher. The AI infrastructure boom has made hardware so scarce and so expensive that companies are raiding their other tech budgets to afford it. Software deals, consulting contracts, mainframe upgrades postponed, shrunk, or dropped, so the money could chase chips instead. Think about what that means. The AI boom isn't just lifting some companies, it's actively draining spending away from others. For the first time, we're seeing hard evidence of AI spending cannibalizing the rest of the tech industry. And the market understood exactly what that implied, because the panic spread instantly. This wasn't just an IBM sell-off. Workday dropped around 10%. Salesforce fell more than 6%. Most major software names sank 3% or more, companies that had nothing to do with IBM's mainframes. Why? Because if corporate budgets are being vacuumed toward AI hardware, every software company's sales could be at risk. Goldman Sachs analysts told clients the miss plays directly into the software bear case. And then came the pylon from Jim Chanos, the famous short seller who called the Enron collapse. His take was even darker. He argued IBM won't admit that it's directly at risk from companies adopting AI itself, that the tools IBM sells could increasingly be replaced by AI. One bad quarter, and suddenly the market was pricing in an existential question for an entire sector. Now here's the honest counterpoint, because this is where most coverage stops and the truth is more nuanced. Look closer at IBM's numbers and the doom story gets complicated. IBM's revenue was actually up about 1% from a year earlier. This was a miss against expectations, not a collapse in business. Its software lines still grew. And a big chunk of the shortfall traces to one specific product, the Z17 mainframe, whose sales cycle simply wound down worse than IBM projected. In other words, part of this is an IBM-specific execution stumble, not proof that AI is devouring the industry. The fair read is that it's both, a company-specific fumble and an early signal of budget pressure. The market sold the scarier interpretation. The reality is probably somewhere in between, and that gap between panic and reality is exactly where investors get hurt, in both directions. So what should you actually watch from here? 3 things. First, July 22nd, IBM's full earnings report and conference call. That's where we learn whether those failed deals were delayed or dead, and whether the software momentum is intact. Second, the other software earnings this season. If Salesforce, Workday, and the rest also report customers diverting budgets to AI hardware, then this wasn't an IBM problem, it's an industry-wide shift, and that repricing has much further to run. And third, memory and chip prices. The whole chain reaction started because AI hardware got scarce and expensive. If those prices keep surging, the budget squeeze on everything else only intensifies. So, IBM's historic crash isn't really a story about IBM. It's the first loud, expensive piece of evidence that the AI gold rush has a cost and someone else's budget is paying it. When one revolution absorbs all the money in the room, the companies outside that revolution feel it first. Whether this was one bad quarter or the start of something bigger, we'll know more on July 22nd. Until then, remember the lesson that applies to every panic: the market always sells the scariest version of the story first, and the truth usually arrives later, quieter, and somewhere in the middle. This is educational, not financial advice. Always do your own research. If you want the clear-eyed version of stories like this, subscribe.